The Income Tax Act 2025. Today is day 30 and I studied section 46 and 47 of the act. Starting with section 46, it deals with specified businesses. Section 46 provides deduction for the capital expenses incurred by specified businesses. It provides 100% deduction on the capital expenses, and it's optional for the SSC. Means the SSC has a choice either to claim 100% deduction on the capital expenses or continue to hold the capital assets in their books of accounts and claim depreciation on a normal basis. The following is the list of the various specified businesses. Like there is cold chain facility for agriculture, meat, fish, warehousing facility for agri produce, laying and operating of cross country pipeline. In case of the cross country pipeline, this was introduced on 1st of April 2009, but there was a retrospective provision made in this for natural gas. In case of natural gas, this deduction will be available from 1/4 2007, and in case of petroleum pipeline, it will be available from 1st of April 2009. Then there are other specified businesses as well. Hotel of 2 star or above from 2010, hospital with 100 patient beds, slum development scheme, and these other businesses which are considered as specified businesses under the act. Now the various conditions or the various notes we need to take into consideration for this provision. First of all, as per this provision, we are allowed a deduction of 100% on the revenue expenditure we incur and a deduction of 100% on the capital expenditure income. But there is an exception of land, goodwill, and financial instruments. In case we purchase some land or goodwill or any bonds or securities or such other things, we are not allowed any deduction. The deduction is only for the capital expenditure other than these ones. And then there's a question, what if this expenditure has been incurred before the commencement of business? Then in that case will be still allowed, but it should have been capitalized in the books of accounts of the business, and then it is allowed in the year of commencement of business. That means when the business starts its commencement, such capital expenditure will be allowed for deduction. And if any capital expenditure has been incurred subsequent to the business commencement, means after commencing the business some years later, then it is also allowed under section 46. The next condition is that the business should be new business. It should not be a business which has formed as a result of split up or reconstruction of any existing business. Next condition is regarding the plant and machinery. The plant and machinery should be new, means first hand. There are two exceptions for it. The first exception is when the plant and machinery which is second hand constitutes only 20% of the total plant and machinery of the business. For example, if in case the total plant and machinery of the business are 100 crore, the second hand plant and machinery can be up to 20 crore, which I have taken in this example as 15 crore. So they'll be allowed deduction on the whole 100 crore, which means including the second hand plant and machinery. The other condition is imported second-hand machinery. If we have imported some second-hand machinery from some other country, it is considered as if we have purchased any new machinery. There is no condition of 20% on this one, because in this case we can see they would have not claimed any deduction because this is some other country's plant and machinery. That's why we are allowing a normal 100% deduction on this asset, the imported second-hand machinery. After that, there is the condition of depreciation and additional depreciation. These will not be allowed in case we claim 100% deduction under section 46. In case, since this section is optional, in case we do not opt to claim deduction under section 46, then we will be allowed normal depreciation under section 33. Further, payment to a single person should not exceed 10,000 on a single day to a single person through any mode other than the specified bank modes. Means we cannot make payment in cash or that cross check or whatever it was, the other than specified modes, more than 10,000 in a single day to a single person. Next condition is in no, we'll study this later. The next condition is regarding the loss from specified businesses. when we claim capital expenditure deduction, we be maybe we get loss in our profit and loss account, because the capital expenditure is a huge expenditure. It often usually it exceeds the amount of revenue, so it's common to have a loss in the profit and loss account in the year we claim capital expenditure deduction. So this loss can be set off only with the profit of specified business, and it can be carried forward for unlimited number of years. Now there are some examples for this. Let's say there is a hotel which is a specified business, means 2 star or more. It is a specified hotel and it has incurred loss of 4 crore rupees. And the same person owns another business which is not a specified business. In our example, it is classes, and that business has a profit of 5 crore rupees. Are we allowed to set off the loss of specified business with the profit of non-specified business? The answer is no, we are not allowed. But are we allowed to set off the loss of a specified business with some other specified business? The answer is yes. Like in this example, hotel, a specified business, incurs a loss, and hospital belonging to the same person has a profit of 5 crore. So this loss of 4 crore can be set off again as the profit of another specified business. Then what happens if there is a loss in the non-specified business and profit in specified business? In that case, the loss from non-specified business can be set off against the profit of specified business, because see, the condition is for loss from specified business that it cannot be set off. It's like the example, this a person has O negative blood, he cannot donate blood to some other person to help him out, but he can receive blood from other people to receive help. Similarly, loss from specified business, we cannot lend this help to a business having profit in order to reduce the taxation, but we can take help from non-specified business to cover our profits, to save our taxes. So a non-specified business having loss of 4 crore, we can set off this loss against the profit of specified business of 5 crore. Then there is another special case where, in case we have loss in one specified business and there is a profit in other specified business, but this specified business is not eligible for deduction under section 46, or it has not opted for deduction under section 46. Like for example, the deduction for hotels, like here, hotel of 2 star or more, is applicable for business commencing on or after 1st of April 2010. In this example, we have a business which has commenced in 1996 or 97 tax year. So it is not eligible for deduction under section 46, and it has a profit of 10 crore. And we have another business, hotel, which has commenced on 23-24 tax year, and it is eligible for deduction under section 46, and it has a loss of 5 crore. So we are, as per the interpretation of ICAI, we are allowed to deduct this, to set off this loss of specified business against the other ineligible specified business. Then there is another special case for hotels, specified hotels 2 star or more, which says in case we incur some expenses on setting up or operating, building or operating a hotel, but we don't want to run the hotel, means we give away the management to some other company who has more experience in this business. Like for example, ITC, we build a hotel and we give away the operations of the hotel to some other business. In that case, we will be able to claim deduction. The one who incurred expenses on the hotel will be able to claim deduction, not the one who is operating, because it's deemed to be carrying on the business, the person who shifted the operation to the other person. The next condition is regarding if we have claimed deduction under section 46, then we cannot claim depreciation or chapter 8 deductions. Then in case a specified business enters into a transaction with some trading business, but this transaction is is apparent that it is carried out in bad faith, means it has been carried out in such a way in order to inflate the profits of specified business, because we may have a lot of deduction available with us, that is an incentive for us to show increased profit. So in case, like in this example, the market value of goods we sold is 10 crore, but we are billing for 25 crore. So this transaction is not in arm's length price. In such cases, the AO will limit such profits to a reasonable level. Then we have the cases of transfer of assets on which we have claimed deduction. The first one is in case we have claimed deduction on some asset under section 46 and then in the future we sell that asset. So the whole amount of selling price will be considered as PGBP, means profit and gain from business and profession. There it will not be considered under the head capital gain, and simply PGBP will be charged on the same sale amount, and no cost can be deducted because we already claimed deduction on the costs of such asset. Like in this example, we bought an asset for 60,000 and claimed the deduction on entire 60,000. And in the future years, whether we sell it for 90,000, 60,000, or 40,000, the sale price will be considered as PGBP, and there is no concept of capital gain in such thing. After that, there is another case. There is a condition actually, which says that when we have purchased an asset in specified business and claim deduction on such asset, then we are not allowed to shift such. We have to use that asset for our specified business for a minimum of 8 years, and in case we do not do that, means we sell it, then the sale case is here, we include it in PGBP. But in case we shift it to some other business which is not a specified business, then this will be the tax treatment. I have an example here which will illustrate everything. In this example, we have purchased AC for 2 lakh rupees and then claimed deduction on the entire 2 lakh rupees in 2024. Then after only 2 years, we transfer the asset from our specified business to our non-specified business. So in this transfer, we will consider the entire, we will have to charge PGBP on such transfer. And how much would that PGBP would be? It will be calculated as the amount of deduction claimed under section 46, which is 2 lakh, reduced by the depreciation allowable in case section 46 was not applicable. Means if we had not opted for section 46, how much depreciation would have we charged on such asset? So for 2 lakh rupees, we would have charged 15% in year 24-25, which is 30,000, and then again 15% in year 25-26, which comes to 25,500. So a total of 55,500 would have been charged as depreciation if we had not chosen to claim depreciation under deduction under section 46. So the amount of PGBP would be deduction claimed reduced by such depreciation amount, which gives us 1,44,500. Now this depreciation, in case it is applicable, we will be also calculating additional depreciation as well, because if we did not claim deduction under 46, so we'd be able to claim both the normal depreciation, which is for 15%, and then the additional depreciation as well. And what happens when it goes to the non-specified business? This asset becomes the part of the block of assets of non-specified business, and for that purpose we have to calculate the actual cost of asset. So for that we have to take the cost of asset and reduce it by the depreciation allowable if it was used for non-specific business from business. Like in case we use the asset from, like we never purchased the asset in specified business and there was no deduction under section 46, we'll assume that case and take depreciation accordingly. So like in this example, we have 2 lakh is the cost of asset and then the depreciation reduced gives us 144,500. This is an example where the PGBP and actual cost match, but it is not true for every case. As like for example, if our specified business was manufacturing of wafer, that manufacturing of semiconductor wafer, then in that case maybe we would have able to claim additional depreciation while calculating PGBP. But in case our non-specified business does not qualify for additional depreciation, then in that case it would have been a different amount here. So there can be a difference between the amount of PGBP and the actual cost of asset. We have to take that into consideration. Here is a summary of transfer of assets. So if in case of specified business we acquired an asset and then claimed deduction on such asset, and then we subsequently sold that asset, the sale price will be considered as PGBP under section 26. And in case we transferred such asset to a specified business, means we acquired it in specified business and transferred it to some other specified business, in such case there is no tax treatment because it's one and the same thing. And in case of sale, the 8-year limit does not apply. Maybe I have said it earlier, but it does not apply here. 8-year limit is not considered. And the case I just discussed right now was transfer to a non-specified business. If we transfer within 8 years limit, then we have to calculate PGBP for the specified business and the actual cost to include it in the block of asset of non-specified business. And in case we transfer after 8 years, means we fulfill the condition of using the asset for specified business for a minimum of 8 years. In that case, there will be no tax treatment for the specified business and the cost will be taken as nil for the non-specified business. And there are a few more notes in the book. First one is in case of laying of cross-country pipeline. In such cases, this is a government regulation that some portion of the pipeline should be made available for use of others as a common carrier. This is a government condition should be considered. Then it defines what infrastructure includes. It includes roads, highways, water supply projects, ports, airports, waterways, and other. Then there are two more conditions regarding cross-country pipeline. The first one is it should be owned by an Indian company or a consortium of such companies or by an authority or board or corporation or any other body established or constituted under the state or central act. Means it either should be a Indian company or it should be like an authority board of the government only. And then it should be approved by the Petroleum and Natural Gas Regulatory Board and it should be notified by the central government. If and further the infrastructure for and these are the conditions for pipeline. Only if we fulfill these conditions of pipelines, which means allowing others to use and owned by Indian companies and these authorities and approved by the Petroleum and Natural Gas Regulatory Board, then only we can claim the deduction under section 46 on pipeline business. And then in case of new infrastructure facility, it should have been entered in agreement with central government, state government or local authority or any other government body. These are the conditions to be remembered. And then there is a condition of audit. Audit is mandatory to claim this deduction under section 63. There is also a case law about hotel which says that which was a case in which a hotel was established but and it and it applied for registration as a 3-star hotel and it only got the registration in the next year. So should it be able to claim the benefit of deduction of under section 46? The answer is yes, because section 46 is a beneficial provision and it should be interpreted liberally, so it cannot be penalized for delay of the department. And they applied it, they are actually a 2-star or more business, so they should be eligible for such deduction. Moving on to section 47, which is regarding agriculture extension project or skill development project. It says in case of agricultural extension project, which means a project to train, educate or provide guidance to the farmers, in case such a project is launched by any SSE, he is eligible to claim 100% deduction on the expenses he incurs, except for the expenses he incurs on land and building. And point is to be noted is that it can be claimed by any SSE. It's not necessary a company or some other SSE. An example is here ITC Chopal, which does these kind of activities. There is an illustration here that, for example, it incurred 50 crore of expenses and then it charged fees from farmers for such agricultural extension program like 15 crore rupees, and it received government subsidy of 10 crore rupees. Then we have to deduct those receipts for calculating the deduction. So in this case, he will have only 25 crore available as deduction under section 47. Similarly, for any skill development project launched, but here is a condition of only companies. If a company launches skill development project, it will be able to claim 100% deduction on all the expenses it incurs, except for the expenses of land and building. purchasing of land and building. That's it. And there is a last point. If in case the SSC opts for new tax regime, he is not eligible to claim additional depreciation. He is not eligible to claim benefit of section 45.3, which is regarding the donation we provide to various institutions for scientific research. He is not eligible to claim benefit of section 46, which was specified businesses, and section 47, which is this agricultural extension program and skill development. That is all.